Hey everyone, it's Michael from Bullion Now, bullionnow.com.au. So we haven't had a Michael's mini rant for a while, so I thought we would do one today. Now, there's been a lot of turmoil overseas with the banking system. There's a lot of confidence leaking out of the banking system rapidly, particularly through the States and into Europe. But it's certainly flowing into Australia. The ripples have started striking here, both from an investment level, so on an umbrella scale, if you like, with the investment funds, but also down to the average person on the street who's taking more interest and starting to take control of their finances and realising the uncertain nature of banking and that they would like to control their finances a lot more. Now let's break down. We've kind of dodged. We haven't kind of joined the discussion about the banks and collapsing and why they did. But I thought today we might actually go through just a bit of a background and then how it might relate to you as more of a bullion investor, as a stacker. So, particularly the scenario with the three banks in the US. So the one that everyone's talking about is the Silicon Valley Bank, but there are actually two others that collapsed. Now, to put them into perspective, if the Silicon Valley Bank was in Australia, and I don't think anyone's ever really focused in on this before, the Silicon Valley Bank in Australia, if it was in Australia, would actually be the fifth largest bank in the country. So it's actually quite a big deal. They keep playing it down as it's a regional bank, it's one of the minor banks, it's all this type of stuff, but it's actually the second largest banking collapse in history. And it's certainly a big deal, particularly if you put it into an Australian term. Now, the way they've got themselves into trouble is it's actually pretty simple. There are far more funds coming out of the bank than going into the bank. That's at its core level. Now, we can get bogged down into the detail. In fact, on a previous video, I did attempt that and Ruben stopped me. But where we can get into the fractional banking and how, for every dollar that comes in, they can actually lend out, $10 or $20, whatever it is, which works really well while the system keeps working. But when somebody pulls out a dollar, then they lose $10 to $20 of their backing and they have to replace it. And that's the situation that Silicon Valley Bank particularly found themselves in, where billions of dollars were flowing out of the bank. And so they had to start liquidating assets to A, cover the withdrawals, but B, also cover the fact that they didn't have those assets behind them anymore with the fractional banking. And so they had to same as when you provide any sort of financial leverage, where when it goes against you, you multiply that out much greater. So the assets that Silicon Valley Bank had, and this is one of the reasons why people in Australia are saying it won't happen here. One of the disadvantages they had was that a lot of their asset was based in what's called bonds. Now, we do use bonds in Australia, very much so. A lot of companies do it. A lot of banks release bonds. So this could happen in Australia, although we are, as I said just before, we are slightly more protected. So what happened with Silicon Valley Bank was that they had, for example, they might have had $100 million worth of bonds that they had purchased, they had invested in, but they were returning something along the lines of, let's say, 1.5%. So this works really well when the interest rates are quite low. The banks are required to invest in either government secured bonds or very high secure, very low risk bonds of a certain grade, and they're only returning 1.5%. Interest rates stay the same, everything works out fine and dandy. Interest rates start going up, this is where it starts to cause an issue, because you can't change this $100 million side very easily. The bond is worth $100 million. But all of a sudden, if interest rates have jumped up to, say, 5%, it means that my 1.5% return is no longer market price. So if I go to sell this $100 million out onto the open market, people are going to say, well, hang on a sec, I don't want a bond that only pays 1.5%. It's not worth that. I know that I can go and write a bond anywhere at 5%. So I'm only going to give you, I'm making these numbers up, but I'm only going to give you $75 million for that $100 million bond. So then the return to me is 5%. So now we've got a feedback loop. We've got money coming out of the bank like crazy. you've got a bank that for every dollar that comes out, they might have to sell, because of that fractional banking scenario, they might have to sell $10 worth of their assets to cover this dollar that's coming out. Not only do they have to sell $10 worth, but their $10 worth is now only worth 3/4 of what it was worth. So they're having to sell far more than they want to. So very, very quickly, they end up in a situation where Silicon Valley Bank did, where somebody has to say, enough, if we keep doing this at this rate, we are going to run out of money. We're going to run out of investments before we run out of depositors trying to claim their money back. And that's effectively what happened. The US government stepped in through the FDIC and said, stop, we will provide the funding so Silicon Valley doesn't have to sell any more of their bonds. We will accept the risk over time, and we will wait until these mature. We will accept the fact that they're only returning 1.5%, and we will just let them play out over time. If you want to withdraw your funds, you'll withdraw it through the bank, but effectively we will fund that withdrawal until such time as these expire. And don't forget, these bonds can run for 30 or 50 years. I don't think Silicon Valley's did. I think their average lifespan was only about 5 or 6 years, but they could run for a heck of a long time. This is why Silicon Valley went pear-shaped. How does that impact you as a bullion stacker? Well, in a lot of ways, but we're going to come back to that in a moment, because now we need to touch on what happened with Credit Suisse, because Credit Suisse is a completely different argument now. So Credit Suisse has been pear-shaped for many, many, many years, well over a decade. I've been hearing rumours of Credit Suisse collapsing or getting themselves into serious trouble for well over 10 years. I'd say it's possibly even closer to 15 years. Now, Credit Suisse got into trouble because of bad management decisions at a high level. Now, again, I don't have secret insight into Credit Suisse. I'm not throwing accusations, but basically, if you read the reports that are out there, you can see that more and more Credit Suisse were making losses on some fairly major decisions, even into Australia. Some of their investments here went rapidly pear-shaped. You can't keep making bad business decisions and eventually not have it hit the bottom line. Now, they've been able to cover that for many years because they've just been taking on new investors. And it only came to a crunch when one of the Middle Eastern, it wasn't a sovereign fund, but it was one of their major banks that provides investment into Europe, said, no more. We've taken almost 10% of your stock. We keep pumping money in. You've hit our limit. We cannot back it any further. You cannot keep making these horrendous losses. Their loss, I believe, and I'm slightly misquoting here because I don't have the numbers in front of me, but from what I understand, their loss in the last year or so basically blew out of the water well and truly any profit they made in the previous decade. So you can see that it doesn't take too much of that before people start saying, hang on a sec, no more. So the Saudis said, no more. So now all of a sudden, Europe is saying, well, hang on a sec, if they're not going to back it, we're not going to back it. So everyone, again, started pulling their funds out of Credit Suisse, and we saw the share price plunge quite a lot. The Swiss government tried to say, well, look, we'll provide, we're talking a serious loan. We're talking, I can't remember how many billion, but it was tens, if not hundreds of billions of dollars as a promissory note. They didn't actually present the money. They just said, we're going to make the loan available. So heaven knows what would have happened if they'd actually withdrawn the whole lot in one hit. But they said that they would do that late last week, and then over the weekend, UBS was convinced to take over Credit Suisse. Now, again, I'm not in the finer detail of this, so I'm just speaking as an outsider. But when you've got a company that closed for business, it was openly traded on the share market over there. It was valued at about that $8 billion on Friday when the markets closed. And then over the weekend, the government has rushed through legislation to say that this bank will be sold at just over $3 billion, and we will basically guarantee and underwrite any losses moving forward for the foreseeable future. There's something fairly rotten at the core. Now, again, how does this impact you? Okay, it impacts you as an Australian particularly, or as someone from anywhere around the world. It does, even if you don't have funds in one of these companies, or whether you even if you don't have shares in one of these companies, it will still impact you in some form. We are seeing the fact that most of the central banks around the world now are rumoured to be saying we're not going to increase rates anymore. Whereas 2 weeks ago, we were going, interest rates were going much higher, and it was a case of how much higher are they going to go. Now everyone's saying they're going to pause or at least come down a bit. So you've got that. And in some ways, people would say, well, that's a plus. You've got the fact that now a lot of money has been thrown out there again. Now, one of the big criticisms for that precious metals investors have been throwing for a few years now is all this money being thrown out of helicopters effectively, just into the street. It's been given away left, right and centre. And now we're suffering from inflation. There's a very good argument to say that they're doing that again. They're just calling it a different name. So if more money is being thrown out there, we're going to see more inflation again. We're also seeing the removal of the risk profile. If you just imagine you're a banker. You walk in to the office today and you say, well, I know the government's going to back me if I make a bad decision. So we're going to take, and they don't literally do this, but you see where I'm going with it. We're going to take all this money, we're going to go down to the casino and we're going to drop it all on black. Because if it comes up black, I'm going to get a massive bonus. Massive bonus, because these guys do. If we make a loss, it doesn't matter, I'm still going to get my wage, and the government is going to cover all the deposits. So we've seen a complete removal of the risk profile, or a complete throwing up in the air of the risk profile. Now this does affect you because every single one of us in some form has superannuation. We have investments in companies. We hold mortgages. All these types of things are impacted by these crazy decisions made by people that should know better in higher positions. So what can you do about it as a stacker, or what can you do about it as the average person on the street to actually limit your risk profile to these decisions that are made on levels far beyond where you and I stand? And one of those many ways, and we rabbit on about this quite often, is to move a lot of your investments, a lot of your assets into hard assets. Now, absolutely, I'm talking about gold, silver, the precious metal range, but there are also other hard assets out there if that doesn't float your boat. You can move into certain select properties, and obviously, different countries, different states, different towns, different streets. Some of them are overvalued, some of them may be undervalued. But you can certainly move into other hard assets, art, currencies. So things like physical dollar notes, $100 notes, pounds, things like that. Yes, I've said, and people are going to say I'm being slightly hypocritical because I say cash is one of the worst ways to hold your wealth, and it absolutely is. I'm not shying away from that, but there are times when actually it's better than some of the alternatives, like putting it in control of some of these people at higher levels. But absolutely, from a stacker's perspective, from a precious metals perspective, I can walk into a store like Bullion Now or your local bullion dealer, and you can hand over your cash, you can have it transferred from a bank into their account, and you can walk out, and I should have grabbed the prop, you can walk out with a lump of metal. And now that lump of metal for the last 5,000 years has carried a value, and it's always, over time, it has always preserved the wealth that the carrier is holding. So you can take that lump of gold and you can take it anywhere in the world, and you can exchange it for another asset or a currency or food or whatever you need to exchange it for. But the ultimate thing is it's in your hand and you control it. Irrespective of any decision that's made outside of it, you control that wealth. You can control what it does. And it doesn't matter what shenanigans are going on in banks. It doesn't matter what shenanigans are going on in corporate life or in government life. You control your investment at the end of the day, and you can do whatever you want with it. You can hold it, you can move it, you can sell it, you can exchange it. But it all comes back to you having control. And that's what this whole soapbox has been about, is the fact that all these things, it doesn't kind of matter why they went down, how they went down, what the finer detail is, and all this stuff that I put up on a whiteboard. while it's interesting and it's good to understand that type of stuff, at the end of the day, what it's actually showing is who has control. And you need to be in control. In my opinion, you need to be in control of it. So grab yourself some hard assets like gold or silver or any of those others. Do some research. Any of those others that are out there that you can control. That's it for now. Make those comments below because I know I'm going to have stirred a bit of a hornet's nest, and that's fine. Make those comments below. We'll jump in. We'll answer some of the questions. We'll enter some of the discussions, and we'll even do further videos on this. So you'll see us do a live stream later on this week. We always try and get a live stream done on Friday at 2:30. That's Australian Eastern, summertime at the moment, soon to be standard time. Melbourne time. That's always at 2:30 Melbourne time. So tune in for that, and you can throw in your questions there or throw them down below, and we absolutely will pound this one out because it's really important that you understand. And it's a difficult topic, but it's really important that you make the effort and that you understand and you ask all those questions, no matter how basic you think they might be. Get them out there, get some answers, and make some informed decisions for you and your family. I'll get off my soapbox now. We'll talk again soon. See ya.